Hello, everybody, and welcome to Investing with IBD podcast, sponsored by Scoofus Capital Management. It's Wednesday, February 2nd, 2022. That's a 2. Lots of twos in there. And it's also Groundhog Day. I'm your host, Justin Nielsen, and along with me, as always, is Irusha Pires. He's an O'Neill Global Advisors portfolio manager, and we don't have a special guest. It's just Irusha being special as he is every week. We're doing a little bit of we time. So, Irusha, how's it going, man?
It's going well. I would say it's 2222. Is that a palindrome? I would say happy palindrome day.
Happy palindrome, Groundhog, everything like that. Maybe we could do a couple of the scenes from Groundhog Day, or you
I
could
would
just
love it.
get on and sing "I've Got You, Babe," like when the alarm goes off, something like that. Actually, I don't know if we have the rights to that, so never mind.
Oh,
Let's
that's
not get
true.
in legal
Yeah.
trouble.
We don't need to.
Well, on today's show, we'll talk a little bit about the follow-through day that we had recently and what that means for your investing. We'll also discuss the reasons we like to be a little bit slower, a little bit more patient. We'll kind of discuss some of the health of the market, what the breadth is telling us right now. So a lot to talk about, and of course, we'll try and put in there some lessons on how you kind of get into a market after you've been out. If you've been on the sidelines, how quickly you do that, and we'll talk about a few of the stocks that are on our radar and maybe even some shorting opportunities that might be out there. So a lot to cover. Irusha, let's go ahead and start it out with the Nasdaq Composite, and let's take a look at what happened on Monday and why that is good and what might be suspicious about it.
Yeah. So Monday was really interesting on a price level. We, especially for the Nasdaq, we are way above the 1.25 threshold that we generally look for, and it finished up 3.4%. But the weird thing was that throughout the day, volume was tracking lower on both the S&P and Nasdaq until like right at the end of the day, and all of a sudden there's this surge in volume, and so it qualified for a fall through day. So what that means is the market is now has a chance to rally. Doesn't necessarily mean it's going to. Doesn't necessarily mean that this is going to work, but it has a chance. And so we look for something to buy, and we buy one stock, buy a smaller position, and we see what happens. Are we making money on that stock or not? And so that's going to give us the initial feedback.
Mm-hmm.
And if this rally is going to end up working over the next few weeks, we will get more and more opportunities to put more money to work.
Mm-hmm. So let's get into the mechanics a little bit of what a follow-through day is. So if we take a look at the Nasdaq Composite, we were in a downtrend. I mean, you could start to see the 50-day moving average line. That's the red line on the chart for those of you that are watching the video. That was rolling over. The 200-day, we had plunged through that. So we were obviously in a downtrend. And once we're in that kind of market environment, we start looking for a follow through day. Just one day is not enough. And we were talking about this for a lot of weeks, how a lot of the best and strongest percentage gaining days in the NASDAQ have occurred amidst a lot of market destruction. You look at some of those top 10, top 15 days, they're in 2001, 2008, 2020 just added a couple of those big gainers during the coronavirus crash. So one day is not enough. What Bill O'Neill, the chairman and founder of Investors Business Daily, used to always say is you need another day that kind of confirms the strength of your rally day. So day one is your rally. That's when you close up, or maybe you have a reversal and you close near the highs. It's still a day of strength, but then you need something to confirm that. And as you mentioned, a lot of times we'll use 1% was the number that Bill used for years and years. But then in the late 90s, we had a lot of volatility, and he started upping that number, that threshold. But then we've been kind of toying around with it, depending on what the volatility is, how much movement is considerable. Because one of the things Bill said was, look, these days should show power. They should be an overwhelming show of force and power. You want it to be unequivocal that this is saying that there's a change. Now we did get that. In fact, a lot of people were looking at Friday's action as potentially being a follow through day. It fell short on the volume side, though, because not only do we need that price action, we also want the volume to be heavier than the day before. And we didn't get that on Friday. we did get it on Monday, as you mentioned, and again, it was incredible because I know I looked 30 minutes before the market closed, kind of just trying to make my guess, and I'm like, yeah, it doesn't look like it's going to hit it. And then in those final 30 minutes, I think I saw a billion extra shares get traded on the Nasdaq Composite. So that did get the volume component. We had the price component, but as you said, that doesn't mean that it's a green light and everything is going to work out roses. If we could go back to 2018, this might be instructive just to let people know. Actually, go ahead and do 2019 in the change date feature. This was when the Fed was starting to talk about raising rates. A lot of people were concerned about Jerome Powell's steady hand on the rudder of the Fed boat, and we did have some follow-through days in this downtrend. We got below the 200-day moving average line. There was a follow-through day that got above the 200-day moving average line and then immediately rolled over. It happened again just a few weeks later where we got a follow-through day. It went up a little bit and then immediately it was a whoosh down. And then we really got kind of oversold. But one of the things I always talk to people about is, Bill used to say, look, I don't use oversold indicators because I've seen something be oversold and then get even more oversold. So that's what happened there. And we finally got that follow through day shortly after Christmas, and it was off to the races for a little while there in 2019. So just realize that sometimes there will be some false starts, and that's why, as you said, a lot of times we like to go a little bit slower.
Yeah, and now, so you don't want to assume one way or the other that it's going to work or not. You just take it as is and say, okay, we have a follow through day, buy one thing and see how it goes. And it's very important to buy something. It doesn't have to be a full position, but buy a little bit just to get that feedback. Because what happens, there is going to come a time. I don't think I can ever remember a time where we had a follow through day and I knew it was going to work. I always have doubts at that point, right? But the difference is if you put a little bit of money to work and after a week or two, you start to notice that stock is starting to make a little bit of progress, or more importantly, it's not going down. That can give you a little bit more confidence to buy the next stock and then eventually the next stock. So it really is more of a mental thing. So you can kind of change that mindset of being afraid of the stock market and start to get more confidence, start putting more money to work in the market.
Now, it should also be mentioned that, at least in my experience, there have been a number of occasions where the first 2 weeks, sometimes after a follow-through day, it didn't just go immediately up. Sometimes there was a little bit more of a pause. Maybe some handles were finishing on some bases. I think back to the December 20th, 2011 follow-through day. I remember that, I was starting to buy some things, but it wasn't really until January started that I really made progress. And of course, that was a very powerful rally in that first quarter of 2012. We had all of these global recession fears. And then it really, again, I didn't feel like it was until January that things really started working for me. And it had a phenomenal move from January until April 4th when it topped. Well, that's when we went to correction. I remember it actually topped, if I remember correctly, March 26th, because that was the day that I walked into John Becker's office and was like, oh my gosh, I can't believe how much money I'm making. And that was the absolute top when I did that. But it was a very powerful rally, and it was, again, incredible, but it was also short. The rest of the year, I feel like, was just about me trying to keep the gains from that first quarter because it wasn't the best environment.
Yeah, so I think you make a key point. Sometimes it doesn't immediately start working. Scott O'Neill always would describe the follow through day. He would say, think of a 747 as it's taking off. It doesn't immediately take off. It's very slow, barely gets off the ground, and just slowly kind of moves in the air. And you almost feel like if you're right near it that you're going to get hit by it, and then finally, after 30 seconds or so, now it's really starting to start the incline because it's just so heavy. And sometimes that happens with these markets. It just needs some time for participants to get more confident that the market is done going down and they can start putting more money to work.
I also want to just share a quick little story. If we go back to the current market, David Ryan who, David Ryan was a protege of Bill O'Neill's. When I started working at the firm back in 1997, the first workshop I ever went to was Bill O'Neill and David Ryan. And I was just impressed with how knowledgeable David Ryan was. Of course, he's a 3-time investing champion, back in the 80s. And, he, again, just phenomenal success. So one of the things he was pointing out to me is on that Friday, you can see how it was an outside day on the Nasdaq. You kind of undercut the prior 3 days, and then you closed near the top of the range, and he kind of looked at that undercut as a possible signal, an early signal that something may be happening, that we could get a rally. But there's also some caution that he was throwing on here that, look, the Nasdaq could very well rally up to the 200-day moving average line and take a pause. So that's a scenario. And this kind of speaks to your point, Arusha, of how you said you've got to be flexible and you've got to kind of think about a number of different scenarios, good and bad. What happens if it gets to the 200-day, rolls over from there, or those 2018 examples where it rolls over? What happens if this just keeps on going? And if you haven't gotten anything, then how much catch-up are you going to have to be doing? How much of that buying extended might you have to be doing? But the other issue is, what do you think of the breadth currently in the market and the merchandise that's available? Because, of course, if you're gonna force yourself to buy something, there's got to be something out there for you to buy. So what do you think of those two elements?
Yeah, well, I think the first thing about like the Nasdaq coming towards the 200-day, that's going to be some resistance there, and it could pause there. But so I'm aware of it, but I don't place so much importance in it, because it's that second part that you were getting to. I'm looking underneath the surface to look for stocks to buy. And if there aren't a lot of stocks to buy, I'm naturally not going to get too much exposure into the market until the market's really ready to go. So a lot of times what I've found in the past is, if it's still not a lot of stocks setting up bases and there's not a lot of opportunities to buy stocks, might buy a few and then it fails, kind of like some of those other examples that we went over. The market might reset, or the market might pull back a little bit, and that might give more time for more bases to set up. Then the next time it comes around, there might be enough stocks that are saying that they're ready to go, and now they're ready to break out and start new uptrends. So it kind of goes hand in hand. But I'm generally placing a lot more importance on the individual stocks, because I think that's where you're going to get a much better feel for the market, and that way you're going to get a lot more opportunity to get into the market if there are stocks breaking out, or if you're disciplined and there aren't stocks breaking out, you're not going to be buying a lot of stocks.
Yeah, that's a great point. So just to kind of talk a little bit about what happened in today's action, I mean, if you want to talk Groundhog Day, it certainly seemed like the breadth was an issue today. The Nasdaq Composite did close up 0.5%, but it was interesting that, looking at the advancers versus the decliners, the decliners beat the advancers by almost a 2-to-1 margin. So, of course, Google had earnings that came out, and it had a pretty strong day. Even though it was well off of its highs, it closed up 7.5%. So that was something that was helping out. I'm noticing that in after hours, we've got Meta Platforms, formerly known as Facebook, that just had earnings come out, and it's getting slammed pretty hard. So we'll see how that ends up tomorrow. But that's been one of the issues, is sometimes you've got these big heavyweights that are pushing those indexes around to a degree.
Yeah, well, I think the Meta Platforms, or formerly known as Facebook, this is a stock or a chart on a technical basis that's been acting weak for a while.
Yeah.
It's been below. It was below the 50-day moving average, below the 200-day moving average. It was making lower lows, and so there wasn't a. If you're using charts to tell you when to get in and get out of stocks, there wasn't a lot of reason to be in the stock unless you're a long-term holder and you've held it for a long time. And in that case, you're probably up so much that even a 20% drop you can handle.
Right.
So it's funny how a lot of times you're going to see that buying action or the selling action way before the news comes out. And so what it does tomorrow, I mean, it's going to be interesting to see. First, that's a 20% gap down. So that's just a monster hit. And I think this happened, a similar thing happened like this 3 or 4 years ago to Facebook. But the other thing, what's the effect that it's going to have on the market, right? We had that Google today that kind of brought the market up a little bit. It wasn't a super strong finish for the market. Google finished okay, but what's going to happen now with this market where we're going back to, if I go back to Nasdaq, you have this rally. It's starting to, though the volume isn't that convincing the last couple of days, getting closer to a little bit more of a resistance area. Overall, this chart for the Nasdaq looks a little weak. And now if you have something like a Facebook starting to sell off, is that going to give more reason for the market to start selling off and maybe come back and start testing the follow through day, or maybe even closer to the lows?
Yeah. So we'll talk a little bit more about, again, how to position yourself, how to find stocks, maybe some look at some of the industry groups that are holding up well in the current market environment. So stay tuned. We'll be right back. Peter Skoufis, founder of Skoufis Capital, has successfully managed money using Bill O'Neill's strategy for the last 17 years. Peter's missed major market crashes, such as the financial crisis of 2008 and most recently the coronavirus crash of 2020. One of his strengths is finding new leadership in new market uptrends. If you would like to talk to Peter and get his thoughts on the current market and what to do now, or get a complimentary review of your portfolio, feel free to contact him at skoufiscapital.com. That's SKOUFIS Capital, CAPITAL.com. And fill out the contact form or by calling 866-562-2634. Protect your capital and don't miss the next market uptrend. Okay, welcome back to Investing with IBD podcast, sponsored by Skoufis Capital Management. It's Justin Nielsen here, your host, along with Irusha Paris, O'Neill Global Advisors portfolio manager, and it's Groundhog Day, so we're going to kind of do some of the lessons that we can maybe learn from Groundhog Day. And one of the things that, I really love the movie with Bill Murray, and one of the things that I think is great about it is this is like the best and longest post-analysis ever. He does a post-analysis on the same day and has all of these chances to get it right. What if I tweak this little thing? Does that get me out of this loop? So let's talk a little bit about post-analysis and how important that is to your routine. And we're also going to talk about, again, Bill Murray in the movie, he had a routine. He also had this repetitiveness to his day, of course. So we'll talk a little bit about that. But let's go ahead and start with the post-analysis, Irusha. What's your kind of overview of post-analysis and what people should be doing?
Yeah, I think the movie, it's repetition and frequency, right?
Yeah.
That's how you get mastery. And so with your routine, you really want to make it as repetitive as possible, and so you don't think about it as much once you kind of get in that habit. So a lot of times I do most of my work on the weekends. And I'll start off going through the Market Smith Growth 250, and it's really easy. You just click on the Stock Ideas button and go to the weekly review. So for the reason why we kind of created this whole Stock Ideas and these tabs was for routines. So on the week, once a week, those weekly routines, you're clicking on the weekly review button, and there's the Mark Smith Growth 250 right there. So the reality is we just created it for ourselves
right.
to really just help us do that routine and not think about it. And so what I'm doing is I'm going that Growth 250. I put it on the weekly chart, and I'm just hitting the space bar and just seeing how are the stocks behaving. Are there any setting up? Arch Resources here just came up. That's the second one on the list, breaking out of a cup with handle, getting the blue dot, showing that it's starting to become more of an outperformer in the market.
And the blue dot means that the relative strength line is at new highs, right?
Exactly. Yep. So the blue dot, what it's doing is it's relative strength line hitting a 52-week high. So it's telling us the stock's becoming more of a leader in the market, and the stock is also breaking out, so it is actionable at this point. So what I'm doing is I'm just going through, taking a larger list, quickly going through the names, looking more at the price and volume action, and saying, are there anything setting up? And if they are, taking those, put in a smaller list so I can focus on them a little bit more. And so every weekend, regardless if you're in an uptrend, a correction, sideways, whatever, I'm doing this because that's how I get the feel for the market. There are going to come times, especially once you're in a correction, where early on in the correction, there's nothing. The stocks are all falling. You want to protect yourself. You're cutting losses. But there'll be a point where you've essentially given up hope on the markets. and you think, oh, we might be down for a long time. But one weekend, you're going to go through this list, and all of a sudden you'll start noticing there are a lot of bases forming. And you'll be
Right.
wondering, where did they all come from? But that's kind of and it is kind of strange, like how it changes from one week and also the next week it's like a completely different market. But that is usually the indicator to me that we're getting close. There are a lot of stocks underneath the surface that they're saying that they're ready to go, as indicated by all these bases forming. And now, if the market comes around, we might have a chance for a sustained rally.
Mm-hmm. So let me ask you real quick. So you've got the Grow 250 list, and it's just to remind people, this list is actually 30 different screens. And these were screens that I used to run for Bill O'Neill. Mike Webster came up with, it was 33 screens. And this is what we would build his watch list off of. So that's what the Growth 250 started out as. This was something that I was running for Bill every weekend, and I would put it into his computer so that he could look at it on Monday mornings and see where the quotes were going and stuff like that. But the Growth 250 isn't necessarily 250 stocks. We cap it at 300, and so for a lot of weeks you saw 300 stocks on the Growth 250 because so many names were coming up. But the last few weeks you've seen that number drop down, and now we're below 250. Not only are we below 300, but we're below 250 because there just aren't that many stocks that are meeting the criteria for the screen. So once you have this screen, and again, it's a pretty comprehensive list, you were talking about using the space bar to kind of go through it quickly, but where do you start? Do you do a sort, or what becomes stock number one that you look at?
Well, I essentially use the default sort that Mark Smith has with the Growth 250, and it is sorted by industry group rank, and then within that industry group rank by composite rating. So the goal is to highlight the stocks that are in the industry groups that are performing the best, and then which ones have like the highest overall rating within that industry group. So that works for me. And Mike Webster came up with that sort, so I'm not gonna argue with Mike there. But in the end, a lot of times, unless I don't have time, I'm gonna go through the whole list. The nice thing is once you get used to a consistent routine, hitting the space bar, reading the charts pretty quickly, you can go through a lot of stocks in a short amount of time. There are only so many stocks that are setting up. And so that's my first goal, is just to go through the names, identify which ones are setting up, and the ones that are not, but that are working well, and I can't buy them at that point. I just want to be able to see the name. So at least I'm starting to build a little name familiarity. So in another month or two, if they start setting up, I might hesitate a little bit more and go, wait a minute, I've seen that name over and over again. What do these guys actually do? And then I'll start looking more into it.
Right. And it's worth mentioning that, I mean, we've been using this kind of sorting mechanism for a number of things. Bill used to use this for the weekly review or your weekend review that we had in the paper. This is also, we had these big red books that would come out every week, the data graph books, and that's how it was sorted by industry group. And what I like about the sorting of industry group is that you kind of have these clusters of similar stocks together, and it kind of lets you know when there's a group move happening, because you'll go through and it's like, oh, here's another. I mean, like right now, oil and gas. You just see so many of the stocks in the Growth 250 are from that sector. In fact, I was kind of running some numbers, and at least as of this weekend, we had 17. The most names were in the U.S. explorers and producers for oil and gas. 17 names there, 15 names in oil and gas integrated, 9 in transport pipeline. Then you had 6 in refining, marketing, the international explorer and producers. That was another 6 in there. So again, just you had 5 of the top 10 oil and gas, and certainly the bulk of the biggest chunk of stocks was from that area. Now you also have banks, super regional, some of the regional banks. Those groups are some of the other ones, but nothing like the 17 and 15 that are in the oil and gas. So that's another way. it just kind of makes it stick out to you as you just even scroll down that list. And then I also noticed that you have some flags on some of the stocks. How do you use the flags?
Well, a lot of times I'll use the flags when I'm actually going through the charts themselves, hitting the space bar. And if something looks interesting in the top left of the chart, you can just click on a little flag, so it puts a little marker there. So that just kind of highlights it. Then later on, when you're looking at a list, you can go and sort by the flag column, and then I can just
Mm-hmm.
click and drag it and put into another list to take a look at. So it's just a way to sort, way to kind of do a triage very quickly.
Right.
So yeah,
Part of that routine, right?
part of the routine, and a lot of this is just being organized and list management and stuff like that, right? It's funny. I mean, it took me years, and I'm still not great at it to
Mm-hmm.
be honest. But it's just being organized.
Yeah.
You're going to see a lot of these stocks, and you'll notice like, wow, this stock looks really good, but it's extended. I want to buy it when it pulls back, and then a month later, it pulls back, and you've lost track of it. And
Mm-hmm.
so it's pulled back for that 1 or 2 days that it comes back to the 10-week line. It bounces off of it and takes off again. And now you notice it 2 weeks later after it bounced and go, oh my God, I didn't even realize it pulled back, right? So
Mm-hmm.
a lot of it is just kind of keeping track of these stocks, and you don't have to check them every day, but the you should be checking the ones that you're really interested in every day for sure. So for instance, right now, as Justin, as you highlighted, when you scroll down, and a lot of times this is what I would do too. I'd pull up the initial list for the Growth through 50, and I just look at the industry names just to see where the concentration is.
Yeah.
And there
It
are
jumps out at you.
it really jumps out of you, especially the banks and
Mm-hmm.
oil and things like that. But there aren't any like normal kind of growth areas that we're
Right.
usually like the whole list. There's nothing here.
Uh-huh.
It's remarkable, but
Mm-hmm.
there are those stocks like the Nvidias and things like that that I always personally like to keep track of. It might be 3 months from now, 6 months from now, where they're ready to go, but I don't want to necessarily lose track of them if they pull back and start forming a base and stuff like that. So I kind of have like a separate kind of list, like you know that I'll check every week, just so I'm aware that where those stocks are in it, because it's so easy once again to lose them. Even some of the best stocks, so easy to lose them because you're going through this pretty intense rotation, and you're looking at oil stocks, and meanwhile all these great stocks that you have a lot more conviction in might be forming bases.
Mm-hmm. And again, I think everyone kind of has to come up with their own routine. I think the routine is important. At least for me, I am definitely a creature of habit. One of the things that just really threw me off in terms of when COVID started was I my routine was so messed up. I mean, I would like forget to brush my teeth in the morning, and it wasn't until like 10 a.m. that oh my gosh, my breath is like horrible. I just didn't have the normal routine that my getting ready routine that I was used to. So I had to kind of come up with a new routine so that I could have that different habit. But I think that everyone kind of has to come up with their own routine, just like Bill Murray did in Groundhog Day, where he had his routine of okay, I'm gonna go under the tree at this point, and the little kid's gonna fall out of it and be in my arms, and there were a number of iterations that he did to get that right, and this is also why I think it's important for a lot of people that you don't throw your routine out just because the market is not looking great, because if you get out of that routine, then sometimes it's a little bit harder to get back into it, or you could miss things just because you're out of the routine, because we never know how quickly or how long it's going to take for the market to turn one way or the other. And so by doing this on a regular basis, having that discipline, it really can go a long way towards your success.
Yeah, I mean the best opportunities really do come during the corrections.
Yeah.
We're not necessarily buying the stocks at that time, but that's when the best stocks are going to form bases, and they'll be the first ones coming out of bases in the next bull market. But the other thing I would want to say is, with the routine, if you're newer to this, you don't have to spend hours and hours on this huge routine initially. Just spend maybe 20 to 30 minutes on the weekend, maybe 5 to 10 minutes on the week during the weekdays, because this way the most important thing is consistency and to let the routine become a habit.
Yeah.
Then eventually, after it becomes a habit, and after you start really getting into it, you're going to be spending a lot more time because it's not a big deal then. But I remember early on, it was very hard for me to
Hmm.
do this because I felt like I had to do a lot, right? And
Hmm.
then, and who wants to do a lot, right? Of just like looking at the charts and all this stuff, right? Especially if you're not really into it at that time. So consistency is the most important thing. Let it develop a habit, and in the end, a lot of this is hanging around long enough until a great market comes around.
Yeah, that's true. Absolutely. So one other thing I just want to point out, because I like to use it a lot, and for people that are maybe a little intimidated about going through 250 names or more in the Grow 250, is that there's the pattern recognition
Yes.
lists, and that just makes it a little bit easier for you to go through fewer names very quickly. So if you don't have a lot of time, I think this is a great place for people to start with these pattern recognition lists. Now, I'd caution you, because breaking out today, a lot of people will just look at that. What can I do right now? And a lot of times, by the time it's on that list, it's almost too late. If you're seeing it when it's there, it's like, hey, everybody's seen it at that point. It's obvious. So I like to really look at the near pivot, those that are maybe setting up, or even the recent breakouts, because sometimes those are ones where maybe it broke out, maybe it's pulled back, maybe it's setting up again. I try to keep an eye on those. Do you have any of the favorite pattern recognition ones that you look at?
Well, for I do, but the first thing and we're first of all, we're not really we didn't intend to make this more of a kind of like a demo for marketsmen,
Right.
but
It was about the routine.
it was about
Groundhog Day.
routine, and we
That's where
built
it came from.
exactly. But the reason why we use marks is because we built all of the routine into
Hmm.
marksmith from what we learned in house, right?
Yeah.
And I didn't even know about some of those stories like Justin talked about where the girl 250 came from, but it
Hmm.
makes a lot of sense now. But so all those lists that Justin was talking about right now, the breaking on today, near pivot, recent breakouts, those are using pattern recognition and going through the girl 250. So if you
Yeah.
don't have a lot of time, this is the place to start off. So near pivot, that's the best one to start because those stocks haven't broken out yet. It's only 16 stocks you have to go through on the
Hmm.
weekend, right? Or maybe the weekday if you have time. So those are the ones when you're newer. If you don't have a lot of time, just go through those lists. Now, when you get a little bit more advanced, when you really start getting into it, the RS line blue dot,
Yeah.
that's one that I like to go through. What I've learned over the years, especially after working in house for many, many years, is that at least to me and a lot of others, relative strength is the most important thing.
Hmm.
And so using that RS line to identify stocks that are outperforming the market and now combining that with the ones that are setting up, that's the RS line blue dot. And so that helps you at least find actionable stocks that are starting to outperform the market. Now, this is a pure technical screen. They might not necessarily have the technicals and all that stuff. So you have to do some of that work too. But this will help highlight some stocks that have potential, at least leadership potential, and will at least get you familiar with some ones that are could potentially do well in the next bull market.
Hmm. Absolutely. One other one I just want to mention, honorable mention for tight areas. That's another list that I like to
Yep,
go to. Yeah, so
there it is.
I usually go. Yeah, there we go. So again, Arusha's in the stock ideas, the open stock ideas, and that's where he's finding a lot of these. I a lot of times will go on the left hand side of the lists and just pull the reports out from there. There's 17 names there. One caution on the tight areas: sometimes you will get stocks that have been acquired. The acquisition news has come out, and so you see, oh, look at this tight action,
Yeah.
but it's kind of false, in a way. It's just because, look, there was a price given. Take a look at Mime, for instance, Mimecast, Mime. Man, that's some really tight action. It's look at all those 3 weeks tight. It's like, well, that's basically the price that was offered for it, and unless something happens where someone comes in at a higher bid or the deal falls through, it's pretty much going to be pinned at that price. So exclude those from your tight tight screen. You will see those pop in there every now and then. But absolutely, the RS line blue dot is a great one to look at. And also realize that list is going to be a little bit larger, but you can sort it by when it hit the blue dot. And so those newer names may be coming to to your forefront.
Yeah, it's normally sorted by the latest one, so you can go
Exactly.
through like the first 10. Yeah, you
Right.
don't have to. The reason why we created it this way is to keep an archive of them, because just because it has a blue dot doesn't necessarily mean you're going to buy it at that point. But they
Mhm.
may pull back, they may set up again, and so this way it's almost like a different type of watch list or a universe list that you can look at when you have time.
So again, have your routine, that repetition, that chance for the post analysis along the way, and kind of do that multiple iterations so that you get better, more organized, and get your process down. Look, it worked for Bill Murray and Groundhog Day, and it can work for your investing. So when we come back, we're actually going to talk about some Groundhog Day related related stocks. So stay tuned for that. Peter Skoufis, founder of Skoufis Capital, has successfully managed money using Bill O'Neill's strategy for the last 17 years. Peter's missed major market crashes, such as the financial crisis of 2008 and most recently the coronavirus crash of 2020. One of his strengths is finding new leadership in new market uptrends. If you would like to talk to Peter and get his thoughts on the current market and what to do now, or get a complimentary review of your portfolio, feel free to contact him at skoufiscapital.com. That's SKOUFIS Capital, CAPITAL.com. And fill out the contact form or by calling 866 562 2634. Protect your capital and don't miss the next market uptrend. Okay, welcome back to Investing with IBD podcast, sponsored by Skoufis Capital Management. It's Justin Nielsen here, along with my good buddy, Ned Ryerson, otherwise known as Irusha Pyrrhus, the O'Neill Global Advisors, one of the O'Neill Global Advisors portfolio managers. So let's go ahead and keep with our Groundhog Day theme. Again, I was a big fan of the movie, so I actually tend to watch it once a year.
I might go and watch it right now after this.
Right. So let's go ahead and start. Of course, we had Puxatawny Phil, and Phil Connors was Bill Murray's character. So let's maybe take a look at Philip Morris. It just kind of shows you that a lot of the names that are working are of the more defensive nature. I mean, we're usually not looking at tobacco stocks, but when you look at the bases, here's that pattern recognition with the cup with handle showing up on Philip Morris. The ticker symbol is PM. Tight action here the last few weeks. What's your take here?
Yeah, I mean, it is acting well. It's not necessarily a stock I'm going to buy, but it's a stock that I'm going to notice because it's telling you something about the market, like you were saying, where if the market, if the money is starting to go more towards these stocks and it's forming a cup with handle, it's really tight action, it's showing accumulation. So it's behaving well on a technical basis. The relative strength line is starting to move near new highs. You're getting some good volume on the weekly chart right here. So overall, technically it's acting well, which is good for Philip Morris, but not necessarily good for the market. And then the earnings and sales are pretty solid too.
Mm-hmm. Yeah, another area that I keep on seeing, as I'm going through screens, it's like, wow, a lot of utilities are showing up. And again, utilities, that's just not something that is typically going to be leading in our type of market. So that's certainly something to be keeping aware of. Also on the defensive nature, AIG. I mean, we all remember Ned Ryerson showing up to Phil and saying, "Hey, let me sell you some insurance." Phil Connors.
Phil Connors.
So AIG, of course, some of you may remember this from the great financial crisis. But here it is, cup with handle. A lot of these insurance names are also setting up. Now, here you can kind of understand a little bit of the fundamental side with the treasury yields getting up there. That is going to benefit a lot of these insurance companies with annuities and so on. So there is something going on there, but certainly you see some bases in a lot of these insurance companies.
Yeah, I mean, technically this is acting really well. It's forming a cup with handle, starting to get over the short-term resistance within the handle, that above that 59.50 area, and then the buy point out of this cup with handle is 62.25. So this is another one that is acting well. The volume on the daily chart, you're seeing more accumulation going on, and it's been in a pretty nice uptrend too. So a little bit of a slower moving stock here, but there's another one where the money's going to when there's uncertainty of what the Fed's going to do, how the market's going to react to earnings, things like that. A lot of times the money's going to go towards quote unquote safer stocks, and so AIG can fall into that category right now. And earnings and sales for the most part are okay. I mean, you're getting accelerated sales over the last 3-4 quarters here, and the earnings were really good a couple of quarters ago too. So
Mm.
overall, this kind of has everything. And now, once again, it doesn't necessarily fit in the kind of classic growth stocks that we look for, but you just kind of have to listen to the market. And if you want to play, you have to kind of go more towards these type of stocks.
At least know where the strength is. But
Yeah.
I think one of the things that you did say though is it's a slower moving stock. You have to manage your expectations. Don't expect a Tesla type move out of an insurance stock.
Yes.
That's just not generally going to happen. I mean, we had Lemonade, of course, the IPO
Yeah.
that came out that was doing something different in the insurance space. But generally, you see a lot of 3 weeks tight. Those are those blue shaded areas. You're going to see a lot of those in there, and there's going to be a lot of this that's going to be like watching paint dry when you look at the weekly chart, and you're just going to sometimes get frustrated it's not going anywhere, but at the same time a lot of times it doesn't necessarily do anything wrong either. It just is a slower mover, so keep
Yeah.
that in mind.
Now we have the luxury of not having to play in the markets, or don't have to put a
Right.
lot of money in the markets when the markets are in a correction or when they're a little bit more challenging. The institutional fund managers, they don't have that luxury, and so they
Mm.
have to move the money more into other areas, and try to kind of play the rotation and look out 3 to 6 months and say, okay, where can we park some money to kind of ride it out if there's uncertainty. So
Hmm.
so that's one of those luxuries that we definitely have. But that being said, yeah, this is one stock that I don't know if I really want to buy this stock on a breakout. This might be more of a pullback stock to buy, maybe off the 200 if I had to buy it, versus trying to buy near new highs, because it doesn't always work when it breaks out.
Yeah, and again, sometimes what the institutions are doing, it's not that they're trying to make money on these; it's that they're just trying not to lose money. Yeah, so
Yeah.
sometimes it's about that capital preservation. And you'll notice that a lot of these defensive names, we generally aren't looking at PE ratios because a lot of the growth names, Bill always felt like you get what you pay for. Sometimes you have to pay up for quality. But right now, it certainly seems like a lot of the higher PE stocks are out of favor, and the ones that are in favor a little bit more are the ones with the lower PEs, especially relative to the S&P 500. Also, as you mentioned, the earnings, a lot of the estimates I've noticed in a number of stocks are not looking great. The 2022 estimates, going a year or two out, a lot of negative estimates there. Now, some of that is due to maybe some tough comparisons, but that's something to just be aware of. So AIG, the fact that it has double digit estimates still
Yeah.
for this, it actually puts it in a unique class, because there's double digit estimates are not that easy to come by for 2022 right now.
Yeah,
Uh,
yeah, that's an interesting thing to note there. It's just that this type of market right now, and markets, the money's going more towards kind of good, solid companies, right? That are just fundamentally sound. They don't necessarily have to have that great growth potential.
mhm. So when you talk about kind of the repetition and the stock that keeps on coming back day after day, Apple, really has to kind of be top of the list, because this is a stock that just never seems to quit. It has its moments where it bases, but then, you wait long enough, and it's right back there on the leadership screens, and looking like possibly a new setup. So what's your take on Apple?
Yeah, I mean, it just keeps popping up like the groundhog here,
Hmm.
and it got back above the 50-day moving average this week. Now it makes it a little bit harder to buy, because it's almost kind of a V-shaped type of recovery here. So ideally, it pulls back and settles down a little bit. Uh, it's kind of hard to see any kind of base right now for this, and so if you're really looking to buy this stock, you probably have to use more like of the 50-day moving average or something, and just kind of use that as a risk management here. But this is one that broke out in November, and everyone kind of doubted it at that point because it was kind of lagging versus the rest of
Right.
the market at
You
that
look at the
point.
relative strength line there.
Yeah,
Mhm.
but it ended up going pretty close to 20%, and suddenly it almost and what happened essentially was that money was looking for some place to go once a lot of the higher growth stocks initially got hit in November. So like, oh, let's just park some in Apple, and
Mhm.
that ended up working pretty well for the shareholders.
Mhm. And for a while there, I mean, we kept on talking about how the indexes were being propped up by the trillion-dollar club members, Apple and Microsoft and Google. And at a certain point, it seemed like those were starting to roll over, and that's when the indexes really got in trouble. But you look at Apple here, and the fact that it's holding above its 200-day or held above its 200-day, now it's already back above the 50-day, where the indexes are not showing anywhere near that type of strength. It does just kind of point out that Apple does have that relative strength, and you see that relative strength line right there at new highs.
Yeah, it's at a critical area though now because it's come up to a little over 180 a couple of times and failed. Uh,
Hmm.
so let's see how the market treats it at this area. Ideally, you still want to be disciplined. You still want to let the stock truly set up instead of just going and chasing the stock right now. And it set up a beautiful cup with handle back in November. It hasn't set up anything at this point, and so it could be still volatile. It could be choppy, and it just makes it that much harder to manage your risk.
Right. And if you even look at, today's high and just kind of draw a line, straight back, you can kind of see even where it is right now is kind of an area of resistance that it's hit before. It
Yeah.
kind of got up there in January. It did break through it, after a little pause in December. So yeah, it'll be interesting to see how it handles itself in the next few days. Now, of course, since Bill Murray was the star of Groundhog Day, we might as well look at Bill, Bill, Bill.com. So what is Bill up to now? Well,
Yeah,
not
well,
much.
here it looks like the groundhog saw its shadow and back in. This one is let's see how far off the 52-week high it is. 47% correction, right? And this is why we
And that's
always
after it's rallied up off the lows.
yes,
Very
that's true. That's a
strongly.
very good point.
Yeah.
So this is one reason, and let's see when it's really started to break the 50-day. So at the end of November, early December, that's when it really started to get hit. And this is why we really respect not only risk but also the 50-day moving average, because when they break those moving averages on heavy volume, a lot of times they need a rest. We don't know how much of a rest and how far down it's going to go, but there are times during a market cycle where they go down a lot further than you can imagine, and this is not unusual for a lot of these growth stocks. Bill's not unusual here. It's 47% after that rally. So this is probably like 50, 60% at the lows. And so
Right.
it just needs a lot of time. So we're bringing this up more as, maybe in a few weeks, if it has a little bit more of a rally, this is one that potentially could be considered a short. Uh,
Yeah.
Now, I think one thing is if we're starting to look at some of these as shorts, we might be getting close to the next bull market at this time.
Right.
If because the stock has been going down for a good couple of months here, but that 200-day is going to be should be some good resistance there. The 50-day might cross below the 200-day pretty soon, and so you could have two reasons for some pretty good resistance if this stock rallies back up towards the 200-day moving average.
Yeah. I'd also say this is where you have to be very careful of saying, you know what, I'm going to buy this when it's at the bottom of a cup, because after this got support at the 200-day moving average line and got up, right around 250 and just was hovering there for a little while in December, I could easily see people saying, oh, look, I'm going to buy this at a cheaper price. This has got to be the low. There's no way it's going lower. It got support at the 200-day. And that just didn't turn out to be the case. They can always go lower. You always have to. I'm not saying that you always have to look at the worst case scenario, the case where it goes down, but you have to consider that and have your line in the sand. If you did try and get this off the 200-day moving average line, you have to make sure that you have some type of stop loss in place because risk management is so important.
And then one final thing, they are reporting earnings tomorrow.
Yeah.
And so we'll have to wait and see on that reaction. Even if it were to jump up, say it jumps up 15% on earnings, you're still not necessarily buying it. At this point, it still needs to go through a basing process. It still needs to go sideways and settle down.
Mm-hmm. So, of course, Groundhog Day, it was the workday that just never ended, kept on going over and over. So we might as well look at Workday, ticker symbol WDAY. And here's another example of a stock that has been in a downtrend for a while. That 50-day moving average line has already rolled over. Try to get up to the 200-day again, got turned away. So this was actually something that we put on as a short for Swing Trader. How do you handle shorts yourself? Do you ever do it, or do you just kind of stay away from it?
I generally stay away from it. I don't play around too much. If I try shorting stocks, I'll play really small, and I'm just doing it
Mhm.
more as testing and just trying to learn more than anything else. I'm just not good at it, so I've just found over the years not to spend too much time there, simply because first I'd lose money during that time, but the other thing that I found was I would get so focused on shorting stocks
Yeah.
that my mentality uh, I was very slow to turn when the market turned because
Mhm.
I'm still looking to short the rallies and things
Mhm.
like that. So I prefer to look more towards the long side and looking for the next bull market because I'm that much quicker to get into the next bull market versus if I'm constantly wasting energy trying to short stocks. Now there are some people out there who are really good at this and it can be very profitable very quickly if you time these well. And you guys putting it on Swing Trader around this time makes a lot of sense because that 200-day is a key resistance right now. It's proven it over and over again. And I guess you can, and I'm assuming you guys are probably just using a little bit above the 200-day as your stop.
Yeah, actually, you know what? I think we put the stop just slightly above 250,
Okay.
right
Yep.
there at 253. So
Okay.
rather than the high of that day, I mean, you can see that today's high and the high of a couple trading days ago was right around the same,
Yeah.
at like 250, 253 or something like that. Yeah.
Yep.
So, it seems like if it gets back up there and really kind of pounds through there, then yeah. On the flip side, we on Swing Trader, we're going to be taking our profits early on this. It's, we're not trying to make a bunch of money on this. It's just, again, to kind of keep people engaged and, show that we're still looking at stuff. And also, as you said, it's just one of those things to kind of take a look at.
Yeah, I mean, Workday is a stock that even on the long side, when we were in good markets, that I just gave up on trying because every time I tried it, it just didn't make progress. It just chopped me around. And there are some stocks, and you can just look on the weekly chart here. There are just some stocks that it's just not in their character to trend well. And this is one of those stocks.
Yeah.
Now, it does have some times where it can really start falling. Now, this was more March 2020, but even to the short side this is one that doesn't trend very well, and so I think it's really smart that if it starts to fall a little bit, take some of those profits pretty quickly.
Right. And, I just want to kind of come back to the point that you made. One of the reasons why, look, Bill O'Neill did some shorting, not very much, but that mentality that you talked about is so important. If you get in your mentality of, I'm looking for these rallies to short into, or, you know, again, he always looked at it as, okay, I'm making some pennies on the short side, but I could be missing the dollars on the
Yeah.
long side. And you just have to make sure there is an optimism that I think all have with our trading. That optimism that overall the uptrend is overwhelmingly in your favor, and the long side is where most people make their money at. And so, just make sure that you're not losing sight of that.
Yeah, absolutely. And I think one big reason why I just stopped, why I gave up on the shorting is once I heard Bill didn't do it and he was having trouble on it. It's like,
Mhm.
then why am I wasting time on it?
Yeah. So, well, that'll do it for us this week. Hope you guys all had a great Groundhog Day. And if you want, you can just watch this whole episode over and over again just to
Or better
celebrate.
yet, just watch the movie.
Just watch the movie. Yeah, probably a little bit more entertaining. Although, before the show, I mean, we had a lot of entertaining stuff in terms of just, if you look at how far back
Oh yeah.
Groundhog Day was from today, um, it's the same as Groundhog Day was from like Alfred Hitchcock's The Birds and Cleopatra with Elizabeth Taylor. So just to put the time frame in perspective of how long ago that was. So hope you all had a great Groundhog Day, and we will be seeing you next time. And on the show, as our guest, we're going to have Mark Newton. Mark Newton is a CMT, so of course that's a designation that Irusha holds himself. He is the global head of technical strategy at Fundstrat Global Advisors, a frequent contributor to both CNBC and Bloomberg. So it'll be great to pick his brain a little bit on some of the technical action that he's seeing out there. So hope you stay tuned for that. We'll see you next time. Thanks for watching. Make sure to subscribe, rate, and review our podcast if you haven't already. We'd really appreciate it. You can also send us your questions and comments to investingpodcast@investors.com. We would love to hear from you and may use your comments on an upcoming episode.
Hey everyone, thanks so much for watching Investors Business Daily on YouTube. If you want to watch more videos, make sure you hit that subscribe button so you don't miss a thing.